Good day, Miss. I'm Angela Cordova, and this is Assignment in Money, Monetary System, and Policy. So, the first question is what constitutes to money nowadays and its role in the economy? My answer is money in modern economies is typically composed of currency, these are notes and coins, and bank deposit held by individuals and businesses. It serves as a medium of exchange, facilitating the transaction of goods and services. Money also acts as a unit of account, providing a common measure of value for goods and assets. Additionally, it functions as a role of value, store of value, allowing individuals to save and preserve wealth over time. Central banks play a crucial role in managing and regulating the money supply to ensure a price stability and promote economic growth. Second question is explain the factors and motives that affects the demand for money. The demand for money is influenced by various factors and motives. Here are some key factors. So these are transaction motive, precautionary motive, speculation motive, interest rates, inflation expectation, and technology. So let's first discuss or let me expound what is transaction motive first. So transaction motive means people hold money to facilitate their day-to-day transactions. The demand for money increases with higher income levels and economic activity as more money is needed for purchasing goods and services. Precautionary motive. Money is also held as a precautionary measure to meet unforeseen expenses or emergencies. The demand for money for precautionary purposes increases the higher income uncertainty and financial stability. Speculative motive. Some individuals hold money as a store of value, anticipating future investment opportunities or changes in asset prices. The demand for money for speculative purposes is influenced by interest rates, expected returns on alternative investments, and confidence in the financial market. Interest rates. The opportunity cost of holding money is a potential interest that could be earned in investing in interest bearing assets. Higher interest rates can reduce the demand for money as individuals may choose to invest in such assets instead. Inflation expectation. Expectation of future inflation can affect the demand for money. If people anticipate higher inflation, they may prefer to hold less money and convert it into assets that retain value better than cash. And for technology, the development of technology and financial innovation can influence the demand for money. Electronic payment systems and digital currencies may change the way people hold and use money, impacting the demand for traditional forms of currency. Overall, the demand for money is complex interplay of various factors, including individual preferences, economic condition, interest rates, and technological advancement. Understanding these factors help policymakers and central banks in managing the money supply effectively. So for the third question, what is a monetary system? How does it differ from a monetary system? A monetary system refers to the framework and set of rules that govern the creation, distribution, and control of money in an economy. It includes institution, instruments, and procedures through which money is circulated, such as central banks, commercial banks, and financial markets. The monetary system determines the type of currency used, the exchange rates, and the overall stability of the financial system. On the other hand, monetary policies refers to the action taken by the central bank or monetary authority to manage and control the money supply and interest rates in an economy. It involves decisions on interest rates, reserve requirements, open market operations, and other tools to influence borrowing costs, inflation, and economic growth. Monetary policy is a key component of the monetary system and is used to regulate the overall functioning of the economy. So, to sum it all up, monetary policies aid the monetary system, or the monetary system is composed or having the basis of the monetary policies for a better economic growth or a better economic balance. And for the fourth question is enumerate and explain the types of monetary policies and does each type work? There are several types of monetary policies that central banks can implement to manage the money supply and interest rates. These policies aim to stabilize the economy and promote sustainable economic growth. The main types of monetary policies include conventional monetary policy, unconventional monetary policy, expansionary monetary policy, contractionary monetary policy. So let's first discuss what is the conventional monetary policy. So conventional monetary policy is the type that involves adjusting the central bank's policy interest rate to influence borrowing costs and consequently the overall level of economic activity. By raising interest rates, central banks can reduce borrowing and spending, thereby curbing inflation. Conversely, lowering interest rates stimulates borrowing and spending, promoting economic growth. This policy works by affecting consumer and business borrowing and spending behavior. And for unconventional monetary policy, these are used when conventional policy measures are insufficient to stimulate economic growth or combat deflation. These policies include quantitative easing or QE, which involves purchasing long-term government bonds and other assets from open market to increase the monetary supply and lower interest rates. Unconventional policies work by injecting liquidity into the financial systems and stimulating lending and investment. Expansionary monetary policy. Expansionary policy aims to stimulate economic growth by raising the money supply and lowering interest rates. This policy is typically employed during periods of economic downturn or recession. By making credit cheaper and more accessible, expansionary policy encourages borrowing and spending, lending to increase investment and consumption. Contractionary monetary policy. Contractionary policy is used to slow down an overheating economy to prevent inflation. It involves reducing the money supply and raising interest rates to discourage borrowing and spending. This policy helps to curb inflationary pressures by reducing aggregate demand and slowing down economic activity. Each type of monetary policy works differently depending on the prevailing economic conditions and the policy objectives. Conventional monetary policy is effective in managing inflation and promoting economic stability during normal economic conditions. Unconventional policies such as QE can be effective in stimulating the economy during periods of severe financial crisis or when interest rates are already near zero. During periods of severe financial crisis or when interest rates are already near zero. Expansionary policy can boost economic growth during recession, while contractionary policy can help control inflation during periods of excessive economic growth. The effectiveness of each policy depends on various factors such as the transmission of mechanism, credibility of the central bank, and the responsiveness of the economy to changes in interest rates and monetary supply. And for the fifth question, give examples of a specific monetary policy here in the Philippines. So in the Philippines, the Central Bank or Bangko Sentral ng Pilipinas, BSP, implements various monetary policies to manage the money supply and achieve their objectives. Some specific monetary policies used in the Philippines include 5. So some of these are interest rate policy, reserve requirement policy, open market operations, and macro-prudential measures. So interest rate policy. The BSP sets the policy interest rates to influence borrowing costs and control inflation. For example, the BSP may raise interest to curb inflationary pressures or lower rates to stimulate economic growth. Reserve requirement policy. So the BSP mandates commercial banks to maintain a certain percentage of their deposit as reserves. By adjusting reserve requirements, the BSP can control the amount of money available for lending and influence liquidity in the bank system. Open market operations or OMO. The BSP conducts OMO by buying or selling government securities in the open market. By doing so, it affects the level of liquidity in the economy, thereby influencing interest rates and money supply. And for the macroprudential measures, the BSP may implement macroprudential measures to safeguard the stability of the financial system. These measures include loan-to-value ratios, capital adequacy requirements, and other regulations aimed at controlling credit growth and preventing excessive risk-taking. These are just few examples of the monetary policies employed by the BSP in the Philippines to manage the money supply, control inflation, and promote economic stability. So that's it for assignment on money, monetary system, and policies. Thank you.